Okay, so welcome back. We're moving on to the selling section now, and of course, we've talked a lot about buying and a lot about pivot points and all kinds of technical analysis of the post breakout action, confirmations, violations. Went all the way back, of course, started with the trend. You remember, we talked about how we're going to start from the left side of the chart and work our way, also start from a satellite view, work down to an aerial overhead and get very microscopic. We've done a lot of that. And now we're at that far right side of the chart where we're getting into the actual selling, taking profits. We're going to give you a bunch of things to look at, just like we started in the beginning with some perspective. We're going to do the same thing with selling here right now. And what we're going to start off with is all about perspective and knowing sort of where you are and what type of technique you're going to be using or what type of readings you're going to be looking for to gauge whether you should be selling a stock or not. So the first thing I want to talk about is what we call the base count. And I guess, Dave, I guess O'Neill sort of started this whole thing with the base count, right? I don't really know of anybody who was talking about counting bases before O'Neill. Do you? Do you?
No, no, and I think he might have even done it after I left. I left in 1998, because I don't still remember him talking about base count, or maybe it came out in some of his studies and maybe in a later book. But the base counting, in my opinion, is you just have to be very careful in counting the bases, because if you're off by, you could think this is, a stage three base or a stage or, fifth base. And I like to go more on how far the stock has moved and how long it's been moving in terms of time. That helps me
Yeah.
measure when I feel that we're getting kind of close to the end of the whole move.
Yeah, and I agree with Dave. Where what I like to do is I like to use a combination of everything. What I'm going to show you today is the base count. We're going to talk about time, how far the stock moved, and then we're going to use where I know I said the PE ratio didn't mean a whole lot for our buying and our analysis of stocks, but this is one area where I do also try to keep track of the PE, and I'll show you how what we use the PE for. But again, the thing I want to make sure that you understand is that, and I think what Dave was starting to try to allude to a little bit, is that this is not this exact science where we're going to, it's five bases and this criteria and you sell. We want to make sure that you understand that this is where, when we get to a certain point, this is perspective. And like I said, where are we on this mountain? So sort of knowing, how much you've come, you're not going to really be able to know where the actual top of the mountain is until afterwards. But you can know how far you've come. And with that, we can get a good idea of whether we're late in the move or we're early in the move, or maybe it's a time where we should really start having our antennas up. And then we start looking for specific sell signals, specific things that are very important. So we'll start off. Let's just talk about what the base count is. It's simply, and as Dave was saying, if you don't know how to know what a base is, then you could be doing this and really counting it wrong. And that's the subjectiveness of it. That we get a little concerned that we're going to put this in somebody's hands, and then they're going to start saying that, oh, it's on the fifth stage base, and it's maybe only on the second stage base. So what we've noticed over the looking at, going back and look at all these big winners and big winners and stocks through their maturation cycle, from the time that they go through stage one, go into stage two, stage three, the topping stage, and then stage four, the declining stage. In the stage two is where we want to be, right? We've already established that. And we look for these bases and buy from these bases through pivot points and so forth, and make sure, it's confirming from the breakout. And at some point, we're looking to sell and nail those profits down. Well, knowing where you are within the stage two helps you determine on whether you're going to be maybe holding for a much larger move, or maybe just trading very quickly. And again, if you're in that early stage, which would generally be the first, 1, 2, 3 bases, that's the early stage. The mid stage would be that fourth base. Then you get into like the fifth, sixth base. You're generally you're generally late in the game, especially as Dave said. If you're looking at, and Dave, the average move of a leading stock is about a year and a half, right?
Yeah, yeah, and sometimes 2 years, and it's usually 100, 200, 300%. So you kind of combine a bunch of these different factors to give you an idea. Hey, we're getting a little bit closer to the end here.
Yeah, you also have to look at the quality of the base, and we're going to talk about that today too. You can see here where you have these, and this isn't a log scale here, but and you're best to use log scales when you're doing this. But you can see here within the stage 2 uptrend. Here's your stage 2 uptrend. That's where we want to be involved in the stock. You've got bases that are forming, right? So this was Amgen. This is back. This is a stock that I was buying actually off of the second base right here. Once it got into a stage 2 uptrend, and actually we had a bear market here in 1990. So as the market was hitting lower lows, this stock was hitting higher lows and was up around all-time highs. Then it made a nice, real big move here. You got into your third stage base, fourth, and then your fifth. You can see how it starts to get much more erratic, and that gets into your stage 3, and then you roll over. Now you're into stage 4. So again, this would be the count as far as, in my count. This is pretty clear, actually. Some are a little bit tougher maybe to discern, but you want to have a pretty decent sized base when you make that count. So here's another one. Here's Yelp going from 2012 to 2015, a little more compressed time frame, but you can see its IPO here goes through some volatility, then gets itself into an uptrend, forms that first buyable base, now has a move, second base, third base, another move out of there. And now you see how you start to get wide. This is on a log scale, by the way. So now you can see that this is much wider than any of these other bases by far, probably 2 times. And now you're starting to whip back and forth through the longer term moving average. In this case, it's the 40-week moving average. And then finally you roll over under it and it starts turning over. And now you're in stage 4. So again, what I like to do is, when I'm coming off of a bear market and I'm coming out of that first or second base, and the way I gauge that is, when did the stock turn into a stage 2 uptrend? So if it just started turning into a stage 2 uptrend, that next base is your first base. That's how I'm gauging it. I'm gauging it when the stock turns into a stage 2 uptrend, the first base from there. So if I'm in that early stage, I may want to hold and try to go for a big move on a stock, because I might have a tiger by the tail. I might have, especially if I'm coming out of a bear market. Now, let's just say the bull market, you've had a bull market. It's been going on for a couple years, and the stock has gone up substantially, many hundreds of percent. And it's been going on, again, for maybe a year and a half, 2 years. And I go and I see I'm on my third base. So at that point, I go into a trading mode. And now I'm usually taking the profits, when I can get them. I might be taking the 20, 30% moves, and even less than that, maybe, if the market is a very late stage and there's a big whipsaw environment, I may be taking very small profits. It all depends on, what we can get out of the market at that time. And then when we start seeing those big wide bases, I would completely avoid this. This would be a base that I would completely avoid. And you'll get good at this over time. Noticing these characteristics. So you're really trying to discern a couple things. One, what stage base you're in, and two, to make sure you're still in stage 2 and you're not going into stage 3. A lot of people, by the time they figure out a stock, they're in that very late stage, and the base is very wide and loose and erratic, and they're in a faulty situation that comes crashing down and fails. Right here, these are your characteristics. And the reason why I point out specifically the stage 3 characteristics is because I want you to understand that when you're in stage 3, you've got to be careful not to chase those later stage bases if they have stage 3 characteristics. So if you count here 1, 2, 3, 4, and you're in your 5th stage base, you can play a 5th stage base, but look and see what characteristics. If they're showing stage 3 characteristics and it's a wide base, then you want to generally stay away from it. Now, another thing too, Dave, sometimes the later stage base you get the blow off, you get the climax at the end. So they could be very profitable and very profitable very quickly, right? But again, that would be where you'd want to sell right into it, and that would be much shorter lived, would you say?
Yeah, and that's usually a climactic move is usually a stock that has been running for a year and a half and is up 2 or 3 times, and then all of a sudden in the last 3 weeks the stock has another run by like 30+% or more, and it's going up. Also, it's also the angle of ascent that the stock is going up. It starts going up a lot faster, or a lot quicker than it had throughout its entire move. And so it's when you get those characteristics occurring, that's when you can just sell into strength and get probably a lot closer to the top than you would be if you wait for the whole thing to start rolling over.
Yeah, and that's what I was saying. Where the later stage bases, sometimes you can get a chance to make that a quick money and those big moves, but again, you're in more of a trading mode because you have to sell right into that because it happens very quickly. So another thing that you can look at, and this is sort of putting it all together to get a picture. And sometimes you don't get all the elements. Like with the PE expansion, we're going to talk about PE expansion here. Sometimes you don't get the PE expansion. You don't see this. But if you happen to see where you're in a late stage base, you're getting an accelerated rate of advance, and now you take a look at the PE and you look at where it was when the move first started. When you first started in that stage 2 uptrend, you broke out of that first base, and where it is currently. If you see that PE has doubled or tripled from there and you're on a late stage base, well, that means that the stock is outpacing the earnings. So it's starting to run up a lot faster than the earnings. And this happens sometimes where the stock doesn't even top forever. It's not like it's a major top, but it could even stall the stock out. This happened with Home Depot in the 90s, where the stock just stalled out for a number of years until the earnings catch up because the price has gotten ahead of it. It's gotten too popular and the price has gotten ahead of it. You can see here, 1, 2, 3, 4. Now you head into, you're not even in your 5th base yet. You come out of the 4th and you started getting very extended here. And this is a pretty good little run here, maybe like a climax run. And now you see the PE has doubled. That's a warning sign. That's a red flag. All right. Let me show you again with lumber liquidators. This happened fairly quickly. So again, notice how you turn into the stage 2 uptrend right here. Right. So now that's when you're going to start looking at the stock. Right? Nothing before that. So here's your first base. That was that ascending base that we looked at before. Second base, third base. So you could even make a case. This is a small base here. So you can even make a case. This is 3, 4, 5, or 1, 2, 3, 4. I tend to, when I'm counting bases, I want to see pretty good sized bases. So again, we go from 20 times earnings. So when we get up here to 50 times. So now we're like, 2.5 times, right? More than 2 times. So the stock has moved up a lot faster than the earnings. So then we're going to start looking for specific sell signals. And in this case, we're going to actually break this down later on. In this case, this was one of the stocks that we showed you earlier that had that faulty setup and then had a low volume out, high volume in, right here off the highs, right when you had that 50 times earnings. CMG, here's another one. So this really made a big move here as far as the PE is concerned. You went from 20 times earnings to 65 times earnings. So that's triple. That's running up 3 times, tripled over the earnings. 1, 2, 3, 4. Now you're on your 5th base here, and then boom, you get the break, and you're coming off here, and that's it. That's the top. Here's that Home Depot example I was telling you about. So here you can see where the PE expanded. It went from, I don't know, what's it look like here? 25 times earnings, up to almost 70, 75 times earnings. So it basically, the PE tripled. And from there, it just went sideways. 1, 2, 3, 4. It was like 5 years where the stock just went sideways. And during that time, you see how the PE comes down now? Because earnings now are outpacing and they're growing faster than the PE now because the stock stopped going up. So now the PE is not expanding because the earnings are coming in and the stock is staying flat. Then stock takes off again, right? It makes this big move. And now again, the PE expanded, and we're not looking at the absolute number. The number's not that important, whether it's 50, 100, it doesn't really matter. What you're looking at is, has it doubled or tripled? And from here, when it starts breaking out again, you're looking at, again, 25 times earnings, almost up to, well, pretty much that 75 times earnings again. It tripled again. And sure enough, boom, that's where the stock tops. Here's, this was Stryker. I was actually in this coming right off of the 91, or actually the 90 bear market on this first base. Now, if you see here, this is a climax run. And when you're late stage, and a climax run is a fast run up that accelerates at a faster rate of advance. And as Dave said, 30% minimum in, just 3, 4, 5 weeks. I've seen them 80%, 100%, some even bigger than that. So this really quick run up, in this case, it was 65% in 11 weeks. But you see, it came from a late stage 1, 2, 3, 4, 5, and then it ran up at an accelerated rate of advance. And you can't sustain that. Once you have that big move, now it's really obvious. And now, you're probably pushing, your valuations now, because the price has really outrun the earnings. Now, some of these can reset. You see here, Stryker went into this stage 3, stage 4, we're pretty much right into stage 4, then right back into stage 1, and then reset right here back into stage 2, and you got yourself a little VCP, and now the whole thing starts all over again, and now you're in a new first base in a new stage 2 uptrend, and you can start counting all over again. Now, here's the key. More importantly for trying to figure out where the stock's topping, because I'm going to get stopped out. I mean, I'm going to set my stop and I'm going to get stopped out. I'm never getting caught in a stock that tops and I'm going to get caught in a big decline, because I'm going to get knocked out with my stop. But what I'm trying to figure out is, are we in a breakaway move? When we get that initial thrust, or are we in an exhaustion move? Are we near the end? Now, what you're going to find is that some of these techniques that we're going to show you right now, basically you're looking at the exact same thing. And in one respect, and Dave, I want you to talk about this, as far as we talked about the MVP characteristics, if you will, where you have 12 out of, say, 15 days up on expanding volume, is a great sign from breaking out of a base, especially if it's a first stage base, but in a stage 2 uptrend. But now, Dave, you're now extended and you're on, base 5, 6, and the stock's made a huge move. And now you get that type of move. Now that's actually a negative, right?
Yeah. And so the stock has very, very similar characteristics when it's coming out of that breakout phase versus as compared to the exhaustion. You get a big increase in volume many times. You get 12 out of 15 days up, and you get a 25 or 30% plus move. And the whole key is, where has the stock been for the last year? If it's been going sideways for the last year, then that's probably the beginning of a move, because that shows you big institutions getting into a stock. But if that's happening at the end of the move, that is usually a sign of the public getting in very, very late, and people have been watching it for months and months and months, and they just can't take it anymore, and they're all just rushing in to buy it. But that's usually at the end of the move, because the stock's already up, 2 or 3 times in the last year. So always keep in mind, where have you been for the last year? And that will give you an idea if it's either the start of the move or the end of the move.
And you're going to use how far you've moved in the last year, how many bases. You can look at the PE, see if you've gotten that PE expansion, and then take a look if you got that accelerated rate of advance. Now, keep that in mind about what Dave just said about, as far as the same exact the same exact conditions in the beginning of a move versus in the later stage of a move. It's the same conditions, but they have the exact opposite meaning, because I'm going to show you a few other things that are exact same concept, where we're going to be looking for the same exact things that we were looking at when we were looking for confirmations. Remember confirmations, you want to see, 7 out of 8 days up. Okay. Keep that in mind, because we're going to talk about that in just one second, and how it turns into being a negative thing.
Yeah, and I just add that this doesn't always happen when stocks top. Sometimes stocks make really nice moves. They don't have anything climactic, and then they start breaking moving averages up. So there's a number of ways of just of determining that a stock is being made, a top is being made in a stock. So it's either a climax top, which is occasionally, or it's something that just runs out of gas and rolls over.
Right. And in the case of Taser, again, if I had, just looked at the stock and not really know what knew what I was looking at as far as the chart was concerned, and that it was not a late stage move, even though it had gone up 12-fold. When I was buying it, the stock had already been up 12-fold, and that's a huge move, but it was a long, long period of dormancy, and it came out really strong. It was a power play. It was a great situation that was still very early, and then it had the acceleration move, and then it had the climax move. You'll get that a lot of times where you'll get the first acceleration when you get like a power play and something that's really strong. Then it'll make another move. It'll have another stage where it accelerates, and that's the part that you're trying to get involved in, because you're trying to get that continuation. And then from there, sometimes you get, as Dave said, not always, but sometimes you get the climax move where it just blows off, and then it just runs up real fast. And the reason why you want to sell right into that is because they come down just as fast, or actually a lot faster. You can see right here, this big, huge down weekly bar just in 1 week. Look how much it gave up, from well over $30 all the way down to in the teens. Here's another one. Here's Qualcomm, which was one of the all-time biggest movers back in the 1990 bull market in the late 90s. So you get the accelerated advance over 9 days. It goes up 80%. But then you see it just sets up, it tightens up. You get a little VCP, and now you get that later move, climax top 73% in just 6 days. Now, so the point I'm trying to show you here is that a lot of times you'll get two sets of these accelerations, and I'm going to show you also on a swing basis. We're looking a little bit longer term here, but I'm going to show you on a swing basis. One stock that I've been watching is Tesla. And again, you got this breakaway move. Of course, you got the quick bear market from the COVID, whatever you want to call it, the COVID decline. And then again, like I'm looking for, once it's in that stage 2 uptrend, I'm looking for that acceleration move. And then you got a climax move here where the stock went from, I don't know, what's it, about 450 or so to almost $1,000, $900 in just 1, 2, 3, 4, 5, 6, looks like maybe 10 weeks or so. So that's a little climax move. Now, recently, Tesla's been coming out of a base again, and it still looks good. I mean, it built another base here, but you're starting to look where now you're coming back to the long-term moving averages. They're starting to flatten out. Now, if you should, get a big break here, and this can't make much of progress, you're starting to look stage 3. Not just yet, but this can morph stage 3 pretty quick. So I'm keeping it, really close here, a close look on this to see if this is going to start getting into the topping stage, and that could take a while. It could take a while for a stock to top.
Mark, one thing I would like to add is when a stock is, and you use Qualcomm as an example, that was a big stock during the 1990s. When everybody it seems like sometimes the market identifies like this is the stock that everybody should own, or it just gets so much attention. Yeah. And when it goes through a climactic run, after just like this, lots of times that signals a top in the whole market. So you just keep that in the back of your mind when there's one stock that everybody seems to be talking about, everybody's focusing on it. It's had a big move, and then it goes into a climax. When that's over, lots of time that corresponds. And you can see Qualcomm did do that right as the market was topping on the NASDAQ. And then it was down, the whole market was down 50% from that till 2003. So it's just something to keep in mind when they kind of anoint this one stock king of the market. When the king is ousted, then it's over for the market.
and even a handful. You could have a handful of them, right?
You could have a few. You don't get that many climactic moves. I mean, maybe when there's and the 2000 was that when you had a lot of stocks having these just gigantic moves. But when you start seeing that happen in a number of stocks, that also might give you a clue that, hey, this could be the end of this bull market that's existed for a few years.
And I think the canaries in the coal mine, as far as what David's talking about here, would, but without a doubt, be Apple, Amazon, Google, maybe Netflix, and Tesla. The FANG stocks, of course, and the sort of extended family of the FANG stocks. Those are definitely sort of the nifty 50 type names of the current bull market. And and as Dave's saying, once they top, and I know nobody believes that those stocks are ever going to top and go down much, but I assure you they will. And that will probably be, the end of the secular bull market. But it could happen months and months and months ahead of time. Sometimes they top a good distance or a good time period before the actual market tops. Let me show you a few names here. So WR Grace was one where, again, I made a big move on this one because it was so powerful coming out of this base here. And you can see pretty dormant, and then boom, it has this big explosion, and you get this first base. As it turns into a stage 2 uptrend, you get that first nice, perfect VCP. It doesn't get any better than this. And I bought this breaking out and was up 20% on the very first day. So this was a stock that was so powerful. By day 4, I was up 40% on it. And I said, there's something definitely going on here. This is just super, super strong. So I held this one. And by the 55th day, remember we talked about before, I said 50 days, especially with the power plays, you want to try to give stocks, if you're going for the bigger move, 50 days is a good rule of thumb to give it a minimum amount of time. So up almost 150% in just 55 days. So again, this was a breakaway move. This is not to get nervous and start thinking like this is, too extended. This is a breakaway move. So here's some signs, and we're going to start looking at some specifics here now. Some signs if you see, to consider selling. So one would be if you count the days. Remember how we counted the days up from a breakout? And I said we want to see, the majority of the days up versus down days. That number is 70%, 70% of the days. So if you have 10 days, you want to see 7 out of 10 days up, definitely 5 or 6 of them at least. If you've got 5 days, 6 days, you want to see 5 out of 6 days up. You're looking for the largest up day. Once a stock is extended, look for the largest up day and the largest spread from high to low, even on the weekly. This is all the same on daily or weekly. If you're having a larger time frame and using weeklies, same exact readings. An accelerated rate of advance. As a matter of fact, when you really want to look for this stuff is when you get an accelerated rate of advance. So now the stock starts running up at a faster rate than it did previously. And that's where you want to start looking and counting those days, looking for the largest up day, looking for the large spread. When you get that largest up day, the largest spread, and you get this run of over 7 to 10 or 15 days where 70%, more than 2/3 of the days are on the upside, and you've accelerated, that's generally within 1 to 3 days of at least an intermediate term top. Also, you might see gaps. You'll see gaps around that time. Sometimes you'll get 2 or 3 gaps, and you get exhaustion gaps. And then you also could look for signs. Now, these are signs to look to sell into strength. So there's 2 ways you can sell. One is into strength, one is into weakness. If we see signs where now the stock comes off and it sells off once it's extended, and it's very heavy volume, that's another big red flag. Or the worst red flag of all, you get the largest drop on the largest volume, either daily, weekly, or both. And that's a super negative. And that actually just recently happened with Snap. We'll see what's going to happen with that. But it was a big break on earnings. We're going to get to everything in just a minute here. Let me show you what this looks like now. So here's a stock that, and the names don't matter. What we want to look at is the chart here and the type of action that we're seeing. So it runs up 8 out of 11 days up. right? So that's 70 some odd percent of the days are up, and you get that largest day, and then you get another 6 out of 8 days up. A lot of times you'll get two sets of these. So with the largest up day and having this big run here, your antenna's got to really be up. If you're not selling into strength, you certainly want to sell on the first sign that it looks like that stock's getting into trouble. And you get right here, you get a reversal, and it's down on the heaviest volume since the entire move. And that right there would be a sign, because of the condition it's under, with that run up and the largest day and all those days up and the stock accelerating at a faster rate of advance. That one day right there would make me absolutely reduce my position or even sell it all. Now you actually get this actually morphs into the even worse sell signal, and that is you get the largest break on the largest volume. And that really puts the kibosh on it completely. So this really has sort of most of the things that you would look for all in one chart. Take a look at another one here. So I think this is Monster. So again, 8 out of 9 days up, right? And then you see how you accelerate here? Look at this rate of advance. You're moving up at this rate, and then all of a sudden, boom, you run up so fast. So you got to more than 70% of the days up, right? Over that period of time. Largest up day. Next day has the largest spread. You're up 47% in 4 days. And you've got a couple of gaps. See, it all sort of comes together right around the time that the stock tops. It's really uncanny how it will do that. These stocks will do this over and over and over. And you start to get good at seeing these various these various warnings, and you'll be amazed at how close to a top you can sell these stocks. Now, I should point out, Dave, this is really important, because I don't want people to get the impression that we're trying to pick tops here, because that's not what trading is about. We're trying to just figure out when the stock is vulnerable and to get out good, to get out with a good profit, and to get out while the getting's good before the stock gets a chance to break. Dave, you've made a lot of money, trading, won investment championships. I mean, picking tops is really the last thing in your mind, right?
Well, it's what you're trying to do is you want to you're never going to pick the exact top. I always say if you can get within 10 or 15% of the top, you're doing a great job, because especially when something is moving like this, a lot of stocks don't have this type of climactic move, and a lot of them just have, just as I said, just kind of normal run-ups, and then they just start rolling over. So, but the key is, if you can sell in the strength, that's great. But if you can get anywhere near the top, you're doing a great job. You don't pick you don't have to pick the top day to make some great money in the market.
Right. The key is just to capture the profit in between where you're buying it and where the stock goes up. And it's real important that you understand that what trading is about. Trading is about making more on your winners than you lose on your losers, and doing it over and over. So that's all about rolling over that edge. And some people's edge is very small. They're trading fast, and they're taking smaller profits, and they have tighter stops, tighter losses, and they roll that over more often. And then if you're a longer term investor, that's going to have its own set of parameters that are going to be, of course, elongated, if you will. So again, but your goal is not to pick bottoms and tops. It's to get on board a stock that's moving. Try to get on something that's moving quickly and time it well. So time value is very important. And then get out when the getting's good and nail down a decent profit, and then do it again. All right. Now, some of these stocks, they may go up, even further after you sell them. But what you're going to find that if you're buying them from the bases and selling them when they're getting into this condition, you're going to be buying the stocks that have the potential to move up big, and you're going to be selling the stocks that have the potential to come in real fast and to wipe out those gains pretty quickly.
Yeah,
go ahead,
Mark. Let me just add one more thing. Is because I've been in some of these throughout my career, going through this great gain, and let me put you into the mindset of what you're thinking about. If you're in one of these things that are going through a climactic run, what what starts happening is every day you wake up and you're expecting the stock to be up. The other thing you're thinking about is that this is the greatest business in the world and I'm making so much money. The third thing you're probably going to be thinking about is I'm quitting my day job and I'm going into full-time trading.
That's right.
or you're thinking about that boat you want to buy, that unbelievable luxury car that you want to buy. That's usually the time where it's time to cut back and start taking profits on something that's going through a run like this. So
It's a great point because I have so many friends of mine that, they're not professional traders and they own Tesla and they own some of these names or maybe even Bitcoin. And they're like, yeah, I mean, I'm not selling this. This company's great. It's going to, I'm hearing it's going to be up tenfold from here. And at some point, they're going to get into a situation where, the stock goes up. Like those type of people that, aren't looking for this stuff are even more likely to hold on to it the more it goes up. Because then they're, like Dave just said, you're so happy and thinking that this is just great. Wow, this is the easiest thing in the world. I just hang on to this thing. It just keeps going up. And they're not even looking for this. And that's when you really have to look for these. You got to look for these warning signs and these sell signals when you're in that position. And again, if you're doing this for a living, you have to get good at this. Let me show you here. This was another one here. I believe this was Hawaiian Air. 11 out of 15 days up. Now, from a breakaway, that's great. I mean, that's and this right here, again, we came out of this base right here. Another little base on base here. Now you're getting a little bit ahead of itself. If I was, swing trading, short-term trading, I probably just sell into this, but maybe I even buy it back over here. It comes off a little cheat area. Boom. Wow. What a nice move. You see how it's an accelerated move now. And now you've got two sets of those, right? You've got the 11 out of 15, 13 out of 15 now. Well, now that the stock has made a good move, and it's accelerating like this, largest up day, 53% in 5 weeks, a gap after it's extended. You put all that together, this doesn't meet. You would say, oh, this meets David's MVP. No, because this is late stage now. This is now getting to where that those same parameters, those same things that you would look for a breakaway is now negative. This is saying exhaustion, and you're going to be selling into that. Show you another one here. Now, sometimes, again, you'll come out of a base, right? You come out of a base here and you'll get this, it'll happen right off the hop. And this is where it gets a little tricky because if you're coming out of a bear market, this is, probably you're not going to want to sell this kind of power. But it still could stall the stock out. It doesn't have to top a stock out. What'll normally happen is if you get these types of indications, you'll at least stall the stock out, and sometimes you stall it out for 6 months. So it's best to sell it, move on, and then maybe come back to it if it rebases. But it's just showing you a sign that it's really getting ahead of itself. So again, we get 3 gaps in a row, right? Big acceleration here. You're up 10 out of 14 days. Largest up day, widest spread, 51% in 14 days. That's a great time. Just sell right into that. Sell right into that. Nail your profit down. At the very least, you can. I'm sorry, I got off that chart. At the very least, you can sell some of it. You sell a portion of it, and now you can backstop. Or maybe you put your stop at and pick a level that you want to protect. Maybe it's up 50%. And you say, well, I don't want to give back. I want to make sure I guarantee myself 30%. So you put a stop at 30%. Or, if you really, you can put your stop at break even. There's all kinds of ways you can do this. You can sell a portion of it and take that off the table, and whatever you take off the table, take an amount that would finance your stop. So now if this stock came all the way back down and you took out your stop, you wouldn't lose any money if you want to play it for a much bigger move. Main thing is that these are the indications that the stock is ahead of itself. Again, here you go. 1, 2, 3, little base right here, ripping out. Look at the acceleration. See, you're in this angle, and then all of a sudden you're at this angle. It's going parabolic. And just in a couple of days, 5 days, it's up almost 60%, right? Largest update, widest spread. Great time to sell right into that, take some money off the table. Here's another. This was Biogen. And again, this did not top the stock out permanently, but it stalled it out for 6 months. A lot of times this will happen on earnings too. You can get where it accelerates and you get, on earnings, and it'll be a good earnings report and the stock will go up. But the stock is already discounted it. It's already made a big move. It's already accelerated. And now they sell the news. So again, here, reversal on the largest volume. So you got a reversal, largest up day, 7 out of 9 days up, and up 50% in 9 days. Again, look at how it just accelerates that rate of advance. Great time to take some profits off the table there. Here you go. Here, another one, Skechers. So this is where you want to be buying. See, right here. See a nice big VCP, tightens up, breaks out. Okay, now you get the natural reaction. You even maybe call this a little cap. Comes up a little more. Another natural reaction, a little base on base. Now you start to accelerate a bit here, right? So now you start counting days and seeing what's going on here. And this just keeps going. And then it really accelerates its rate of advance. So right here, this is just getting way too ahead of itself. Largest up day, largest spread, big gap, and it's very extended. And you see how just a couple days later, 1, 2, 3, maybe 4 or 5 days later, that's where it tops, and then it rolls over hard. And look how much it gives up in just a short period of time. So usually, like I said, when you start getting all these things to cluster, you're usually looking at 3, 4, 5 days. You'll get a top in the stock. Okay, another one here. You're moving up at this rate of advance, and then you accelerate outside that upper channel. Largest update, largest spread, big gap, extended. Again, time to sell. So right into that. It's very hard for people to sell. For me, it's not. I've been doing this for almost 40 years, and when I sell right into strength all the time. People don't realize, but institutions also sell into strength. And, Dave, maybe you can talk about that because, these big institutions have to get out when they can. See, it's not like you where you could just dump the stock. And if you got 1,000 shares, you can sell it anytime. When a big institution's got 2 million shares and the stock has made a big move, they want to nail that profit down and they got to sell all that stock. They got to get out when they can, not when they want to. So they use the strength. Go ahead, Dave.
Yeah, they're looking for liquidity, and so when there's a liquidity event, and that could be a gap up on earnings, or it could be an announcement of a split, or something favorable, and a lot of people are attracted to it and are trading it. And the volume really picks up, that lots of times that's their key, or that's their window of opportunity to lay off some of the stock that they had bought at lower prices. So they're always looking for a liquidity event to sell a stock into strength.
Right. And if you're coming out of a base, you're breaking out of this nice big base here. This is Jack in the Box. I actually bought this stock. This came out of this nice big base, beautiful, big VCP. That's great right here coming out. But now you make a nice move and now you get extended and you start running at a higher rate of advance. Now it's a whole different story. Now you're looking to sell right into that. Stocks distribute on the way up. People don't realize that, but they actually distribute on the way up. O'Neill talks about this in his books, I believe. So again, even from a shorter term standpoint, even when I'm just swing trading, and most of my trading is swing trading or even short term trading, depending on the environment. So I'm not. A lot of people think I'm playing for these big giant moves. I am, but I'm usually trading around that big move. So I'll go in, the stock will run up. Maybe it's 30% move, 20, 30, 40% move. I'm out. Rebases, I'm back in. Sometimes, big move, I trade in and out of the stock 3, 4, 5 times along that big move. So I'm just looking for, these same characteristics. Here you got 8 out of 10 days up, and then you get the big volume reversal right there. Boom, nail some profits down. See, it stalls it out. Now it goes sideways, and you get a beautiful VCP. Look how tight. I mean, this is just a perfect entry. Now, again, you come up, 9 out of 10 days up, you get 2 clusters of it. 7 out of 9 days up, reversal on heaviest volume. Boom, right there. See, because you're in that position now where the stock has gotten extended and it's had all these days up, these 70% or more, now you start keying in and looking for that key reversal. Now it becomes a key reversal. And when you get it and you see the heavy volume, boom, that's where you get out. Okay, so there's a chronology to this. All right, here's another one. This is Fair Isaac, of course. Comes out of a perfect. I traded this. It was a perfect base. I remember this one well. Look how nice this VCP is. Now, see, right off the hop, 7 days in a row up. So you wouldn't want to sell there. That's a breakout. That's coming right out of a nice base. 7 out of 10 days up. That's acting perfect. That's exactly what I want to see. Now it bases a little bit, natural reaction, back into new high ground, tennis ball action. Okay. But now we've gone through, 1, 2, maybe 3 or 4 natural reactions, and now another 7 out of 10 days up. Okay. So now I'm starting to look at it. And if it starts getting top heavy, I'm going to start looking to nail my profits down, because now I got a decent move. I've gotten a couple clusters of the 70% up days versus down days, and I'm getting extended. Then right here, bang, price break on largest volume. So if I hadn't already sold into strength, I'm definitely getting out there. And now it can't rally, starts curling down, 50-day rolls over, and now I'm definitely getting out of any remaining shares there. Now, this is where, and again, I think, Dave, I think you talked about this, and you own Crocs, and you had some during this decline here. This is a rule where this is really telling you that the institutions are unwinding their positions and they're running for the exits, in mass. And that's when you have the largest price break on the largest volume, daily and or weekly. And usually when you get it daily, by the end of the week, you look at the weekly and you get it weekly as well. In this case, that was the case. So this is actually a weekly here, but you can see you've got the largest price break here since the beginning of the move on the largest volume. That's it. Out. I don't care. No questions asked. I'm out. You were in this stock, right, Dave?
Yeah, and I had been selling because this was a break on earnings. The earnings were actually very, very good, but they weren't as good as expected, or they didn't guide higher than that they had done in previous quarters. And so I had sold the majority of my position going into those earnings. And right when it broke on that day, I sold the rest of it out and I was gone. And you can see what happened to that. The stock went from on the break from 75 and almost went completely under. I guess it went to $1 a share. So yes. You might think, oh gosh, I'm too late to sell, but boy, you'd be a lot better off being out at 50 or 47 where it closed than at $1 a share.
Yeah, I mean, and then sometimes some people buy a stock and this happens like right after they buy it, shortly after, and they're down big on it. And now they set a stop at 5 or 6 or 8%, and instead they're down 15 or 20. And now they're like, oh, I'll just wait till it comes back. No, you take the 15% loss and you get out. This is a major, major sell signal. Don't wait, don't hesitate, and don't kick yourself if you sell it and then it comes back. Yes, that might happen, but you have to protect yourself, for the unlikely event, or in this case, a likely event that the stock's going to go precipitously lower. Here's a perfect example where if you were buying this late stage base here, again, count the bases. You've got came out of this first base, second, third. You're in your fourth or fifth stage base here, and this is one. I know it's real tight here. You can't really see it, but we looked at this earlier. This was in the confirmations and violations. It broke out here, and then boom, comes in, and you got that failure where you had the low volume out, high volume in. So you had the violation. Now again, right away, boom, you're in it, and next thing you know, you're underwater. Your first loss is your best loss. Under these conditions, you want to be out. Even after the stock came off, here's your biggest break, right? Big break, and now the stock is cheap. This is where analysts, and you'll start to see, the stock's cheap. It's a buy, valuation, and the earnings have not, in many cases, have not yet come in. They haven't put the bad earnings on the table. Remember, we talked about this in fundamentals where the stock breaks. It looks cheap because the earnings have not yet come out. The stock's discounting it. There's an intelligence there. So the smart money knows what's coming down the line. So it really is expensive. See, now the stock breaks again, and the stock has this huge decline. And then all of a sudden, look, it's all of a sudden totally overvalued. The PE jumps huge while the stock is down 90%, 90% lower stock price. PE jumps huge. Why? Because now the earnings come out. Now the losses, now the problems that this stock was discounting. All right. So your first loss is your best loss. Here's an example. This was a stock I bought. Symbol was TME. Perfect base. I mean, came out beautiful, beautiful base here. Really great breakout, held up well. And then you see it got accelerated here. If I remember, this was on earnings. I can't remember when I sold, but I'm pretty sure I sold right into this rally. And then you get into a little base here, which I generally don't like when you get an extended move like this and it accelerates its rate of advance and you get a small base. These always seem to give me trouble. And this was starting to get a little popular. Breaks out, everything's looking great, and then look, wham, right in. See, that's a sell signal. Out. You're out of there immediately. If you blew through your stop, just get out. Don't even hesitate. And of course, look at the decline. Now, if we look at that, I think we have the weekly, right? Yeah. Look at the weekly. Now, it comes out of this nice big, IPO base. Again, same thing on the weekly. Look at that huge weekly decline and look at the volume. Again, like I said before, that's not Aunt Betty selling. No, those are institutions, and that's not one institution. That's a lot of institutions piling out of that stock. Something changed. So even if it hasn't been announced, I assure you something changed with the prospects of that company. Now, like I said, you can sell on the upside. You can also sell on the way down. These are some of the things. Of course, this is sort of like the last case scenario here. If you're getting this happening, you've obviously missed the chance to sell off the top or sell into strength. But you can also use, and I don't use moving averages very much, certainly not with like moving average crossovers and things like that. But there is one technique that I use with a moving average that I like to use, particularly in the early stages of a bull market. So you get a bear market and you start to bottom and stocks start setting up, and maybe you get a follow through day off the low, stocks start breaking out, and you start owning a few names off the lows of the bear market. That's when you're most likely to get onto a really big winner, because you're getting it after the market's corrected, and you may be getting some of those first movers that are holding up the best, and you got a real leader there. So they can go, and Dave, you've of course done the studies at O'Neill too. We've run these numbers. They can go an amazing distance and never before they close below the 50-day moving average. So what I call the 50-day break even or better rule. Basically, this is how it works. So you buy the stock breaking out, you set your stop, right? When the 50-day catches up to your break-even point, right? It catches up to your break-even. If you bought it at 100 and the 50 days at 90, and maybe you've got to stop at 95, 5%. But now you buy it, and 2 weeks down the road, the 50-day is now up at 100. You now move to the 50-day as your quote-unquote trailing stop. That becomes your stop, and you just stick with the stock until it closes below that 50-day. And in this case, you can see you went through a little acceleration move here, and then the stock, and you had a gap over here, and then finally it closed below it, and you nail in a 64% profit. Now, because this will keep you in. I mean, again, this is not a huge profit, but I've seen stocks just go 500% before they close below the 50-day.
Yeah, one thing that somebody has to know is that if you really like the company and it's got unbelievable, just great fundamentals, that eventually, if the stock just goes sideways, that 50 days is going to catch up to it. And if you like it really, if you want to go to a longer term move, then if it's just basing and going sideways, and now the 50-day goes through it, you can hold on to it, but if it breaks that base, then out you go. So it all depends on what people's time frame is, but eventually that 50-day is going to catch up to it after it goes sideways.
Yeah, and it'll act sort of as a trailing stop. So again, if you want to let the stock go through a basing period, and as long as it's holding that base, that's fine too. Again, if you're playing for a bigger move, And these are all going to be, these are all things that you can use in conjunction. As we move on here, we're going to give you a few other tools that you can use in conjunction. But just looking at this, straight from just a stop, using it as a stop loss mechanism. Again, you can see right here. Buy point coming out of this power play, right? You set your stop here, say below the pivot point, right, or below the below the handle, if you will, or the cheat area. So now it moves up, and now the 50-day line comes and catches up to the break even, which is this is a month later or so, and now you switch over to that. So now it's a break even or better now. You've put a trailing stop that's break even or better. So the worst that you're going to do is break even, of course, unless it gaps through it. And now you can see this just holds and holds and holds, and then finally you close through it here, and now you've locked in about 100% gain, which you may not, you may not have held. You might have gotten a nice little quick gain here, and you're out because you get emotional about it. This is a non-emotional way to stick with a name. And again, this is something that I would recommend using in the beginning of a new bull market. If it's, there's been a bear market and you're fortunate to grab some of the key stocks that have broken out first, maybe in those first few months as the market turns up off the lows, this will keep you in some of those leaders. Here's Foster Wheeler. I actually bought this right here. This is actually breaking out, had a little bit of a gap and broke out on earnings. You can see again, 50-day moves here, and you get this accelerated move. And again, you might get you might get emotional right here and sell it. So this locks you out and then turns around and goes even higher, but you locked yourself in a nice little profit here, and it gives you a nice mechanical method. Ford, here's another one with Ford coming out of this little base right here. You see 50-day catches up, and now it acts as a stop here, and then boom, you lock in a 40% profit right here. All right, so now, Dave, this is something that you've observed over the years, and actually, Dave actually turned me on to this observation a while back, years back, and that is where I what I like to do is, Dave, is use what you've showed me with the lower lows. I like to use the lower lows on the daily and the weekly in conjunction with the 50-day. And if it stays above that 50-day and we don't get, 3 lower lows, then I sort of just, try to stick with it, for those bigger moves. Again, coming off of right now, in the current environment, I've been like scalping, profits. But there's times where, off of a major bear market where, I'll hold stocks from much bigger moves. And again, if that's what you want to do, if that's your goal, you want to use these things in conjunction. Dave, why don't you talk about, the lower lows? And remember when we were talking about how institutions they'll come in and they'll add to their positions on those couple days down, couple weeks down, and explain why this phenomenon happens like this. And this is just looking at Burlington. Well, I just want to say real quick, I'm sorry, Dave, but you remember this is the one that you actually turned me on to, Burlington. If you remember, I think the weather, you said it was going to be, it was going to be exceptionally cold, and that we had a much colder, winter, and that you were thinking that, they're going to Burlington, they were selling all those coats and stuff, but you turned me on to this stock, and it was perfect. It held the 50-day for the whole entire move, or the 10-week right here.
Yeah, well, this is just something I observed by looking at a lot of great winners. I just found that a lot of them, they rarely had 3 weeks down in a row, and that's 3 lower lows, and you can see where marked out on the chart that a lot of these had just 2 lower lows, or this Burlington Stores had the 2 lower lows, didn't have 3 lower lows until all the way up at the, after a very, very large move. And so what that's saying is that this is probably a lot of institutions weren't selling this stock during that entire move. But when you got 3 weeks in a row, 3 lower lows, that's telling you that somebody was in there selling, or maybe a number of large sellers were in there selling, and they have a millions share position. Maybe they had 2 or 3 million shares. They couldn't get out in a day. They couldn't get out in a week, and it takes them like 3 weeks to get out. And especially when you see it on accelerated volume or larger volume above the average weekly volume, as you see on this chart, then that tells you that, hey, this is probably the signs of an institution moving out and reducing their position. So it's just something that I saw in very consistent big winners, and it's something that you might want to look at to keep you in for a longer term move.
Yeah. Now, it doesn't mean that, I mean, 3 lower lows could mean the stock could be down 50% with 3 lower lows. So we're not saying to just hang in there.
Right.
There's that third lower low. But what I like to do is watch it. And if it's above the 50-day, if I see those 3 lower lows, and then I'm looking at the 50-day also, but let's just say you didn't have any moving average, and the only thing that you were going to wait for was the 3 lower lows. Look at the distance that this stock goes. This is the only time it had 2 low. There was no more than 1 lower low this entire move, except these 2 times, which there were 2 lower lows. And then finally, when it finally topped out here, you got the 3 lower lows, and you got to close below the 50-day, in this case, the 10-week moving average. So just in conjunction, again, it works as a good trailing indicator or reading to keep you in a stock.
Yeah, I would just add that those 3 lower lows have to be somewhat substantial. They can't be, by a lower low by 1/8 of a point, and then a week later, 1/4 of a point. But I'm talking, it hits one price, and then then the next lower low is 2 or, like a 5% lower, and then the next week it's the same thing. It's so you have to correspond it with volume and some of the other things that we
and if it's David, if it's on heavy volume, it's even more ominous.
Yeah.
Of course.
Yes.
So again, if it's coming off on light volume, and the lower lows are 10 cents below each other, you've got to use some. It is somewhat subjective, but we're trying to give you some mechanics here. So again, let's take a look here. So Alibaba, of course. You see, again, here's where you want to be buying. And by the way, Dave, you just, I don't know if everybody caught that, how Dave just dated himself with calling it 1/8.
I know. I'm sorry.
I know you caught yourself. I know you caught yourself. Yep, 1/8 of a point.
Yeah.
Who nowadays would talk in eighths unless they had at least were in the market for 30 years?
Yeah, no one even knows what the equivalent to 1/8 of a point is.
Yeah, I know.
Well,
I was just going to say, I wonder if some of these kids trading, even though, with 1/8 of a point.
It's probably, what is it, 12.5 cents or something like that?
Yeah. And then we used to trade in the teenies. Remember teenies? At 16.
Oh, yeah.
Yeah. So Alibaba, again, see here, look at this nice big base. Look at this tight VCP action. That's where you want to be buying. Now, again, look at this stock. It doesn't have 3 lower lows. It doesn't even have 1 lower low, more than 1 lower low, 2 lower lows. This is the one time it has 2 lower lows and holds the 10-week the entire time, right? The whole time it's holding that. So you can wait. If you want to try to, hold these. This is a great way, especially if you're coming out of a large base, coming out of a bear market. You might have a leader by the tail. And if you want to try to stay with it, again, here's another one. Control 4 group. Comes out here. See, only one time did it even have a couple lower lows. So actually, is this? Yeah, 1, 2 lower lows, and it's happened above the 10-week, above the 50-day moving average. Let's see, is there another one more? Yeah, and this is Shopify. Again, 2 lower lows right here. See, never had. So the point is that if you waited for the 3 lower lows, you would have kept you in this entire time. See, it would have kept you in. Just that simple thing to watch would have kept you in the stock if you want something to keep you in the names. So we're going to talk about more, and there's, of course, I'm going to talk a lot in risk management about stops and so forth. But we gave you some rules here, and right here, there's a page. I'm not going to go through all of this, but this is for your own edification. Some rules for selling into strength, some general rules, some general guidelines for selling into strength, and some general rules for selling into weakness. And then, of course, here these are red flags. Any of these happen, you've got yourself. This is a red flag. So, see, these are some of the things to look for sell signals and for red flags. Now we're going to in your workbook, you're going to see there's some pages like daily routine. This is actually, we skip this section and we do this during live trading. So daily routine will be in live trading. So we're going to jump around a bit. There's also over here, you see putting it all together. This is really for your own, for your own edification to look at. Just some examples of putting together the earnings and overlaying some things here so you can see some of these examples. But what we're going to do is we're going to get into risk management, and that's sort of the real, the most important, I think, of all this whole workshop is the risk management section. And this is where, every year that I've ever done this is sort of where particularly when it was live and I can look out into the audience, it would just be like a catatonic state once I get through with this risk management section, because not only is it a big section, but there's just a lot of amazing stuff here that will open your eyes and really give you what's needed the most. So we'll be coming back when we come back with risk management, but right now I think we're done here for the day. And thanks, Dave. I'll see you when we come back. Dave does not do risk management with me. I usually do this alone. I'm not sure if I'm going to have Mark Ritchie for a section of it. Not even sure just yet. I'll make that choice tomorrow. But again, we'll be back for that, and we'll see you soon. All right. Have a rest. Rest up after all this information and digest it. All right.